Does this mean recession is going to come here? Like I told you earlier when we were talking, my bigger fear is a reverse market crash, which Venezuela just went through, which all of a sudden the rates get lowered and Dow and S&P goes. And Dow goes from 33, 40, 45, 50, 55, 60, just goes boom.
Is that just the dollar losing its purchasing power?
Yes, exactly. That's what happened.
Imagine this. Everyone is talking about the risk of a market crash, but there's an even bigger danger looming on the horizon that could reshape wealth and inequality as we know it. It's called a reverse market crash. What if instead of prices collapsing, we saw them shoot up uncontrollably? If this sounds surreal, think about what happened in Venezuela. As hyperinflation took over, the stock market skyrocketed. But it wasn't because the economy was doing well. It was the illusion of growth, and those at the top were the only real winners. Let's rewind a bit. Over the past few years, trillions of dollars have been pumped into the economy. This influx was meant to support everyone during tough times. But here's the catch. Money flows where it's valued most, and it doesn't stay long with those who aren't prepared to manage it. This is the fundamental law of economic gravity. So where did this cash end up? In the hands of those who control value, corporations, asset owners, the top 1%. For those who don't hold assets, the effect has been quite different. The money hasn't stuck around, and inflation has only made things harder. And here's the twist. Imagine the Fed decides to drop interest rates down from their current highs. Let's say they bring them down to 5%, 4%, or even lower. What do you think would happen to a $900,000 house? Suddenly, it might be worth $1.4 million. And while that sounds great, if you already own a home, it makes things even harder for those trying to buy in. The gap between the wealthy and everyone else grows wider. For those waiting on the sidelines, the dream of homeownership moves even further out of reach. And this isn't just a theory. We've seen it play out. In every scenario, lowering interest rates creates what I call a reverse crash.
The more we're printing, like, for example, a Michael Jordan card years ago, a BGS 9.5, sold for $78,000. Like, oh my God, that's crazy. But then all of a sudden, all of these boxes kept entering the marketplace of 1986 Fleer. So guys started buying these things and they were sending more to get graded at Beckett and PSA. The more they got cards graded, that $78,000 card, BGS 9.5, became a $60,000 card, $50,000 card, $40,000 card, $30,000 card. You can probably buy BGS 9.5 today for $20,000, $25,000, okay? So the inventory increases the more we print money. The more you print dollars and it's more accessible, the less it's valued, the less it's worth. So these are some things that's going on today. You know, like you sit there and you're like, okay, so does this mean guys are not going to make a lot of money? No. You're going to see the first trillionaire in the next 24 months because none of this is going to affect the guys at the top. None of it. This printing money, every time they print money, the guys at the top make more money. If there's anybody that should be against printing money, it's low and middle income families. If there's anybody that should be against printing money, it's them. If there's anybody that's for printing money, guess who it is? The guys at the top. Why? Because the poor and middle America can't keep money. They spend it. And when they spend it, what do they buy? A product owned by somebody in the S&P 500 or other people who have businesses. Money flows up. They can keep printing money all they want. So when low and middle income families are like, look at these guys, all they care about is themselves. Let that bill pass for $2.7 trillion. You simply look at them and you say, you have no clue how money works. You have no idea how money works. Now, guess what? Let's print $10 trillion. Rich are okay with it. You ain't gonna get the rich complaining about printing $10 trillion or $5 trillion. BlackRock's gonna be like, all right, cool. We're at $8 to $10 trillion of money in our ETFs and we're buying up a bunch of different companies. We're buying up all these properties today. Right now it's gonna be nothing, but in the next few years, you have to go through us and we dictate the market and we're gonna own it all. And what are you gonna do about it? You know, these are a lot of different moving parts that is going on to me. And again, for me, the idea of middle America not being able to make the money they need to make to be able to afford a house, send their kids to school, live in a nice place, enjoy some of their dreams, maybe not the biggest ones, but some of their dreams are going to become a reality. Middle America is getting smaller and smaller and smaller every single time we print money.
This is the terrifying reality. The rich get richer, but the poor and middle class get squeezed. That $900,000 house you couldn't afford last year, now it's out of reach by an even wider margin. Rates drop, values surge, and suddenly owning becomes a privilege that fewer and fewer can attain. This isn't just inequality, it's inequality on steroids. This is the dark side of inflation. It stretches the middle class thinner, pulls the working class down, and accelerates wealth to the top. So what's the effect? What happens to everyday people? Those paying rent may end up trapped there because the cost to buy is beyond reach. And with soaring costs and stagnant wages, many are already feeling the pinch. That's why we're seeing strikes across the country. People are saying, I can't make ends meet. They can't afford to save, let alone buy a home. This is creating a society where ownership of homes, assets, and financial security becomes a rarity, something only for the elite. But it goes deeper. We can trace this trend globally. Look at what's happening in Venezuela. Their market chart may look like a success story at first glance. Massive, consistent growth. But the reality is grim. It's a facade, a house of cards built on inflation and unsustainable policies. The currency is worthless. The wealth gap is staggering, and most people are suffering. Meanwhile, the 1% keep cashing in, their assets appreciating at dizzying rates. They're the only ones truly benefiting, while everyone else is left struggling to get by. And that brings us to the bigger picture here in the US. Right now, interest rates are at levels we haven't seen in years. Inflation is high, the economy is uncertain, and many people are on edge, wondering what's next. Real estate values are sky high, stocks are volatile, and the cost of living keeps climbing. So you might think that lowering rates would help, but that would just inflate asset prices further, making them even more unattainable for most. Let's take a step back and look at how we got here. During the pandemic, the government rolled out $1.4 trillion in stimulus checks. People paid down debt, credit card balances dropped, and the stock market started running again. But as spending returned to normal, so did debt levels. Today, credit card debt is at an all-time high, nearing $1 trillion, and the cycle of borrowing continues. And here's where it gets interesting. All that spending ended up boosting corporate profits, padding the pockets of the top 1% who own these businesses. This is where we see the silent hand of the reverse market crash at work. When people are encouraged to spend but not to save, to consume but not to invest, wealth flows upwards. It fills the profit margins of corporations and inflates the portfolios of shareholders. But for the average American, they're left with debt, rising costs, and shrinking opportunities. Now, Jerome Powell, the Fed chair, is in a tough spot. There's immense pressure on him to lower rates, especially with elections around the corner. Many are hoping he will, thinking it'll bring relief. But if he succumbs to that pressure, we could be setting ourselves up for an economic sugar high. Short-term growth followed by a long-term crash. If rates go down too soon, it may look like prosperity, but it's an illusion. In reality, it could set the stage for years of financial hardship. So where does that leave us? How do we navigate a time like this? Diversification is key, and now more than ever, it's about balancing assets, maybe some in equities, maybe some in gold or Bitcoin, which is back on the rise as institutions like BlackRock roll out Bitcoin ETFs. But it's risky. Nothing is certain in a market like this. And for the first time, there's no clear path because we're dealing with factors we've never faced before. Unprecedented money printing, the lasting impact of a pandemic, a shift to remote work, and geopolitical tensions. Nobody has a playbook for this. Not even the experts can predict what's next. This is why, more than ever, the focus is on diversification and prudence. The 60-40 portfolio split that advisors have recommended for decades, it's not the safe bet it once was. Bonds have been crushed and stocks are volatile. So what do? You hedge, diversify, and prepare for anything. And here's something that should really make you think. In the span of just 6 months, we printed 40% of the total money ever issued in the history of the United States. The outcome? Asset prices shot up and real estate values soared. We experienced a mini Venezuela right here at home. The housing market is inflated, and everyday people can't keep up with the rising costs. If Powell holds his ground and keeps rates high, it'll be painful, but it's necessary. Going back to low rates would only fuel another fake boom, temporary, unsustainable growth, followed by a crash. It's a warning to those in the mortgage industry and beyond. The days of easy money and 3% interest rates are behind us, and they're not coming back. Businesses that relied on those low rates are facing a harsh reality. And for those who built their success on unsustainable models, the future is uncertain. It's a reminder that we need to be cautious, that success isn't guaranteed, and that what goes up too fast is bound to come down. For the savvy and the prepared, this could be a time to thrive. Those who diversified, those who hedged their bets, they're the ones positioned to come out on top. But for the unprepared, the reverse market crash could be a harsh wake-up call. This isn't about fear, it's about foresight. It's about understanding the forces at play and preparing for what's to come. These are volatile times, and as Jamie Dimon said, this could be the most dangerous period we've faced in decades. When leaders like Warren Buffett, Charlie Munger, and Ray Dalio are sounding the alarm, it's worth listening. They're not hoping for a crash. Their wealth is tied to the market too. But they see the risks, and they're warning us. The truth is, there's no easy solution. We're in uncharted territory, but with awareness, with preparation, and with diversification, we can navigate this storm. As always, I'll keep bringing you insights, updates, and strategies to help you stay informed. If you found value in this discussion, don't forget to like, subscribe, and stay tuned for more content. Remember, this isn't just about today. It's about planning for tomorrow, staying vigilant, and positioning yourself for whatever comes next. Thanks for watching, and I'll see you in the next video.